Welcome to this explainer. Today we're diving deep into Septerna. This is a highly speculative biotech stock that is absolutely challenging the way we think about conventional valuation models. Let's get right into it.
Okay, let's dive into this. Septerna is a clinical stage biotech company with an incredibly ambitious mission. They're developing oral small molecule medicines targeting what are called G-protein coupled receptors, or GPCRs for short. You can think of GPCRs as the cellular inboxes receiving critical messages from the body. They're literally one of the most important classes of drug targets in all of medicine. But here's the kicker. What makes Septerna so unique is their proprietary native complex platform. This tech is designed to preserve these GPCRs in their actual native biological environment, and by doing that, researchers can discover mechanisms and molecules that are just notoriously difficult to find using conventional screening. They're applying this across immunology, endocrinology, and cardiometabolic diseases.
Because of this incredibly broad approach, if you're looking at Septerna, you aren't just buying a ticket for one single experimental drug. You're effectively making a twofold bet here. First, sure, you're betting that their current individual drug candidates are going to successfully navigate clinical trials. But second, and this is arguably the much bigger deal for long-term valuation, you're betting that their platform acts as a repeatable engine, an engine capable of churning out commercially valuable GPCR drugs time and time again.
Right, so let's look closer at that pipeline, starting with their biggest near-term value driver. It's called SEP-631. This is an oral negative allosteric modulator, which, is basically just a fancy scientific way of saying it acts like a biological dimmer switch. It turns down the overactivity of cells that cause severe inflammatory conditions, specifically targeting a receptor heavily involved in mast cell activation. So even though they're a platform company, the market is laser-focused on this specific asset right now. Why? Because it represents the very first major clinical validation of their underlying science.
And what's really interesting about the data here is the sheer potency they demonstrated in phase 1 trials. It is genuinely remarkable. At a microscopic dose of just 10 milligrams, taken once daily, we're talking a tiny fraction of a standard aspirin here, Septerna reported a dose-dependent and ultimately complete inhibition of skin wheal formation. And the best part? They achieved this with a tolerability profile comparable to a placebo. This is a massive milestone. It gives us concrete evidence that this mechanism actually works in humans, which totally elevates Septerna above your run-of-the-mill preclinical biotech.
That brings us to their second major catalyst, SEP-479. This one is being developed for hypoparathyroidism. The commercial proposition here is just staggering in its simplicity. I mean, it could totally disrupt the market. Right now, the standard of care relies on daily injectable hormone replacements. SEP-479, on the other hand, is an oral small molecule. Think about that. If you can replace a daily injection with a simple daily pill while still effectively balancing the body's calcium levels, the commercial advantage is just enormous. They actually kicked off their phase 1 trial for this back in April 2026.
But wait, beyond their internal pipeline, Septerna has what we can call a strategic hidden asset. And this is honestly one of the biggest reasons to view this company differently from your typical small-cap biotech. They have a strategic relationship with the pharmaceutical titan Novo Nordisk. This collaboration is squarely focused on the discovery, development, and commercialization of oral small molecule therapies for obesity, type 2 diabetes, and other cardiometabolic diseases. To cement this partnership, Septerna received a massive upfront payment in 2025 of $195 million. To put that into perspective, that is the budget of a major Hollywood blockbuster just handed over before a drug is even commercialized. So the crucial point here is this. Novo Nordisk isn't just tossing them pocket change, they are committing substantial, serious resources toward GPCR-based drug discovery using Septerna's tech. For a clinical stage biotech, this is the ultimate external validation. It screams to the market that industry heavyweights believe Septerna's platform has tremendous value way beyond its own internal pipeline.
Now here is where we need to be incredibly careful with our financial analysis. Don't fall into the classic valuation trap. Septerna's reported revenue jumped dramatically from $1.1 million in 2024 to a whopping $46 million in 2025. But when you break down that $46 million, you see it consists of $26.8 million in amortization of Novo Nordisk's upfront payment and $18.6 million in research services. Right? This is partnership accounting recognition. It is not commercial product sales. You absolutely cannot value Septerna using a conventional commercial pharmaceutical revenue multiple. It just doesn't work that way.
So while the reported revenue might be a bit of an accounting artifact, The underlying cash actually generated from these partnerships provides Septerna with its single greatest structural advantage, and that is a fortress balance sheet. Why does that matter so much? Well, it completely separates them from the vast majority of their cash-strapped clinical peers. This is exactly where the company becomes exceptionally interesting from an investment standpoint.
Let's look at the numbers. As of March 31, 2026, Septerna held a staggering $522.1 million in cash, cash equivalents, and marketable securities, for a company that reported just $13.3 million in operating losses for that exact same quarter. I mean, the massive disparity between those two numbers represents a phenomenal liquidity position.
To really grasp how the market views all this, we have to look at the enterprise value. At the time of the source report, Septerna had a market capitalization of roughly $2.15 billion. But when you back out that massive $522 million cash pile, you arrive at an approximate enterprise value of $1.63 billion. For you as an investor, this means the market is effectively valuing their actual operating pipeline and that entire GPCR platform at considerably less than the headline equity value suggests.
So why does this cash matter so much? Simply put, it solves the classic biotech investor trap. We see this all the time, right? You find a company with a brilliant pipeline, but a terrible balance sheet, which inevitably leads to massive, value-destroying shareholder dilution just to keep the lights on. Septerna's management has explicitly stated this cash extends their operating runway at least into 2029. That severely reduces near-term financing pressure and dilution risk. Plus, the interest income on $500 million actively reduces their reported net loss. But above all, it buys them the absolute most precious commodity in the biotech world: time. Time to generate major clinical catalysts before they ever need to go back to the market for more capital.
Okay, let's take a breath and ground this excitement in reality for a second. If you follow this space, you know the pipeline risk here remains substantial. Septerna is still firmly a clinical stage biotech. Their lead asset, SEP-631, it had a great phase 1, but it hasn't demonstrated phase 3 efficacy yet. Their second asset, SEP-479, is only just entering phase 1. And the rest of their discovery programs, they're even earlier in development. The reality is, this entire multi-billion-dollar valuation is predicated heavily on future probability-adjusted cash flows, not current earnings. Because traditional price-to-earnings ratios are virtually useless for a loss-making biotech, we have to rely on a scenario-based valuation framework. Let's walk through what this looks like. In a bleak bear case, say SEP-631 disappoints and the platform validation slows down, the estimated value drops heavily to somewhere between $20 and $30 a share. In a steady base case, where phase 2B progresses normally and the Novo collaboration remains productive, we're looking at a solid $55 to $75. But in a highly enthusiastic bull case, where SEP-631 actually proves to be a genuinely differentiated therapy and additional partnerships start hitting substantial milestones, well, the value could absolutely explode to $90 to $120 or more as the market fully recognizes just how valuable this platform is.
So how exactly do we get to those higher valuations? It's all about monitoring the specific catalysts that'll trigger the next major stock re-rating. First and foremost, in the second half of 2026, we're going to see SEP-631 enter phase 2B, initially targeting chronic spontaneous urticaria, which is severe, persistent hives. Then, looking to late 2026 or early 2027, the market will finally get the phase 1 clinical data for SEP-479. And of course, throughout this whole period, investors have to constantly monitor the cash burn to ensure that expected 2029 runway limit holds firm.
To hit that aggressive $120-plus bull path we talked about, a very specific sequence of escalations needs to happen. Step 1, SEP-631 must produce compelling phase 2B efficacy results. Step 2, SEP-479 needs to show strong early clinical evidence, basically proving that their success isn't just a one-off fluke. And Step 3, the Novo Nordisk collaboration, or their own internal programs, must demonstrate that this native complex platform can repeatedly turn out successful candidates. If all these steps fall into place, Wall Street will stop valuing Septerna as a risky single-drug company and immediately start pricing it as a premier GPCR platform biotech.
But to be completely objective, we have to acknowledge the bear case risks here, and they are steep. The most obvious is clinical failure. Look, a great phase 1 proof of mechanism in no way guarantees phase 2 efficacy in actual sick patients. Second is commercial viability. SEP-631 is stepping into a fiercely competitive urticaria market against well-established biologics and antihistamines. It might work biologically, but still fail commercially. Third, having an amazing discovery platform doesn't guarantee you can manufacture commercial drugs at scale. And finally, just brace yourself for massive biotech volatility. If you invest in this space, you know clinical stage stocks can easily swing 20 to 50% in a single day on trial results alone.
Also, from an execution standpoint, there's a vital continuity factor flying a bit under the radar. Septerna's Chief Medical Officer, Jay Kim, is actually stepping down to pursue an opportunity closer to home. He is staying on in an advisory capacity during the transition, though. And while this isn't a thesis breaker by any means, for a clinical stage company heavily reliant on trial execution, a change in clinical leadership is exactly the kind of metric that sophisticated analysts watch very, very closely.
So, bringing it all together, taking into account the exceptional cash position and the Novo Nordisk validation, weighed against those steep clinical risks, what's the final verdict? Well, this is a long-term speculative buy, but your key takeaway today should really be about portfolio sizing. This is a venture-style, high-risk, high-reward play. It belongs as a strictly capped 1 to 3% allocation within a much larger diversified core portfolio. Ultimately, Septerna's $522 million cash buffer gives them the absolute luxury of time, and Novo Nordisk gives them immense credibility. The technology is undeniably fascinating, but the multi-billion-dollar question that will ultimately define this stock's future is this: can Septerna actually convert its discovery advantage into a commercial triumph, or will it fall into the dreaded clinical valley of death? With SEP-631 entering Phase 2B, we are about to find out.